seeing the problems of South Africa, the slowdown in growth, the balance of trade situation deteriorating, and generally the situation of some despondency in the country, I suddenly felt that the world is such a similar place. Because when you're sitting in a country, it seems that, well, no one else is going through this. But it's a very, very similar story just all over the world. And there is a sense that the growth has slowed down immensely. Eurozone technically in recession. India's growth, which used to be very, very high for about 10, 12 years, now down to 4.5%. So there's a lot of soul searching going on. Is something wrong about your country? The global situation is bad. That should never become an alibi, because no matter what the global situation, you can do better and you must strive to do better. And I have to say about your country that I can see that there is a mood of despondency about the growth having slowed down. Your mining situation, I know that there is turmoil over here, there are difficulties. The global exports have gone down. But also you have to remember, and you know, the inequality in South Africa, which is just stark. So there is a great distance to go on that. The world is an unfair place. I mean, people who do well in the world try to assure us that the world is a very fair place and everything is all right. But we know that the status quo is not fair. There is a lot still to be achieved, lot still to strive towards. South Africa indeed has reason to be proud of its historic achievement. I remember as a student, mid-1970s in London, we never thought that South Africa would be able to shake off apartheid. The grip was so strong. We would cheer from a distance like most student movements, but we were not optimistic. That within 2 decades from there, this would be shaken off is a huge achievement for the country. You should feel proud of that. At the same time, you've got a very, very difficult journey ahead of you. This is one of those rare countries that combines the first world with the third world. Very few countries have to combine that. India does a little bit of that. India has extremities, but nothing like the extremities that you have over here. So the struggle has to go on, not just in terms of pure economics, but political economy to make society a fairer society so that people have a better chance. I want to today take this opportunity to bring at this great university to address generally the problems of emerging economies in today's changing global order and the crisis in Europe and United States, the economic slowdown and its fallout and what it means for emerging countries in a cluster. At one level, the policymakers are very similar anywhere in the world, whether you're talking to policymakers sitting in Delhi, Nairobi, or in Pretoria or Cape Town. The conversation goes very, very similar. They are all educated, roughly reading the same kinds of books, same kinds of texts, and there is really very little to distinguish one place from another. But in other ways, you realize that in terms of ways people think, the collective beliefs, there are dramatic differences. So look at the crisis in the world. 2007, the US subprime crisis is starting. 2008, you have the Lehman collapse. By 2009, there is the widespread financial crisis in developing countries, but also the crisis by now has escalated to the rest of the world. So by 2009, it's widespread, and you're feeling that pressure even in India. By 2010, you get the start of the Eurozone crisis. All the emerging economies which were doing well have slowed down. 2011, the S&P's downgrade is, of course, a very landmark event, and I will come down to that just now. But by the end of 2011, the Eurozone was in actually very deep crisis. There was a risk that some of the European banks would go belly up, and that's when you had the LTRO, which was an injection of money, a huge amount of money, $1.3 trillion, given as loans to European banks. Something like 800 banks took that, and the immediate crisis was averted. But indeed, the world situation was very bad. Come into 2012, and we are seeing that the financial crisis has abated. Two things happened for the financial crisis to abate. The decision to inject the LTRO funds into the system meant that the risk that there would be banks would go bankrupt. That had been averted by by the end of 2011 and early 2012. And then in the middle of 2012, you may remember that Mario Draghi came up with a statement, whatever it takes, and announced the program that it would stand behind the sovereigns of the Eurozone, whatever it takes. And when a central bank makes a statement of that kind, the nerves are assuaged and the borrowing costs of nations go down. So the financial crisis abates, but it's evident by the end of 2012 that the financial crisis may have abated, but the real economy of the world is in crisis. The entire Eurozone is in recession. You know, an economist defines a recession technically in terms of 2 quarters, which means 6 months of negative growth. So for 6 months, the Eurozone is in negative growth. Japan has been stagnant for a very long time and continues to be stagnant. United States also hits a road bump by the last quarter of 2012. Countries which were doing very well actually previously over several years, which India was one of them, China, some slowdown, Brazil, quite a bit of slowdown actually in Brazil from doing well. So by 2012, the financial crisis seems to have abated a little bit, but the real economy is doing not very well. Anyone experiencing each of these crises separately will think of each of them as a separate event. Yes, there are some links between these. We know that in the world of finance, very often there is something called infection. A crisis in one country infects another country in very strange ways. And economists, especially those who do finance, I was talking with one of your finance professors just now, they've done a lot of work on infection of finance from one country affecting behavior in another. That's there. But I believe actually something more than that is happening. When you have multiple earthquakes, one earthquake after another, ordinary people treat that as the luck of the draw, one bad incident happening after another. But we know, geologists, for instance, have a sense that when tectonic plates under the earth are shifting, you get multiple earthquakes, and at the end of that, some of the topography of the land could change. New mountains arise, new lakes get formed. I feel that it's very, very likely that the world is in the middle of such a tectonic shifting of plates taking place of the global economy. And a lot of these crises that you're seeing from 2007 unabated, one after another coming, each one of them is a distinct event, and there is, of course, a proximate cause of each of these crises. But together they are beginning to reflect a changing structure of the global economy. Emerging countries and even low-income countries are trading much more among themselves. And this is a chart that shows you the increase in trade, and that is giving a little bit of resilience, and there is no getting away from that, that emerging economies, whether it be South Africa, which is actually the top end of the emerging economies, it's fairly rich, to the bottom end of it, countries like India, despite the slowdown, the fact that you're talking of 2.5% in South Africa, 4.5% in India, when a large part of the world is in negative growth, speaks something about the resilience of the emerging economies, developing countries, middle-income countries, lower middle-income countries, their resilience. And part of the reason is that they are trading more and more. But the resilience is not endless. The world is a very, very connected place. And this graph tells you a little bit that after the Lehman collapse, an incident which takes place in the United States, suddenly emerging economies find it difficult to borrow. People wouldn't lend money to emerging countries, lower income countries, because there has been a crisis in the United States. Now, I want you to understand the connectivities of the world. And here I'm putting on my hat in India. August 2011, I was still doing my advisory work in India when S&Ps did something which again, one of those things that you never expect will happen. United States is downgraded. So as a destination, it's a slightly riskier destination for money. What happened was money began rushing into the United States. So after US downgrading, money started going into the United States and leaving emerging countries. That was a period when the rupee, Indian rupee began losing value, the South African rand began losing value, Brazilian currency losing value. Money is just going into the US treasuries. Money was also being pulled out of Europe and going into US treasuries. And what has happened? Why is this happening with the US downgrade? In retrospect, we understand what has happened. With the US downgrade, there was fear that there's going to be global turmoil. US is the biggest driver of the global economy. With the US downgrade, there will be trouble. Once there is trouble, money looks for safe havens. Safe havens in the olden days would be largely Europe and United States. But now, Europe was not being considered a safe haven for a reason. Reason had to do with fault lines in the construction of the Eurozone. And this is now very easy to understand. Suppose when there is turmoil and you're looking for a safe haven, you put your money in Spanish government bonds. In the olden days, Spain had a central bank. So you would not expect a default by Spain, because if the Spanish government was in great difficulty to pay you back, the Spanish government would turn to its central bank and effectively tell the central bank, please print some money and pay back these people who have invested money in the government bonds because we don't want to default. But do you see, with the construction of the Eurozone, no single country in the Eurozone had access to its own central bank. So what could never be thought of earlier, a major European country defaulting, now became a possibility because Spain could not be sure that it would be able to persuade ECB to create money to repay the Spanish borrowing that had been done. Likewise for Italy, likewise for Portugal, likewise for France. So you are worried about putting in your money into European countries. United States still had a government and its own central bank. So if you put money in US treasuries, you know that a default is very, very unlikely because the government still owns a printing press for cash. It's not a good thing to do, to print money and pay back, but you know that push comes to shove. That's what the United States would do, so you're not worried about a default from United States. So what happened with the S&P's downgrading was money started rushing into the US Treasury, and that's when a lot of the writing, which people had begun realizing, that in Europe, one mistake that had happened in the construction of the Eurozone was that indeed, that there was a lot of fiscal autonomy. Each government could do its own borrowing, but there was one monetary authority. And these things, you're always wiser after the event. So we shouldn't say that it's so obvious. It was not obvious to anyone. It was not even obvious to investors putting money in European governments. And if you look at one chart, I wish I had that chart, that I don't, is the borrowing costs of the Eurozone countries till 2008. Spain was borrowing by paying the same interest rate as Germany, as Italy, as Portugal, roughly the same. So investors were treating all the Eurozone countries as the same. You know, now they are a monetary union, so whether I invest in Spain or Germany, the risk is the same. In 2008, they realized that the Eurozone is a monetary union, it's not a fiscal union. You could have put in money into Spain and there could be a default there, whereas there may not be a default in Germany. And suddenly from 2008, if you look at borrowing costs, it opens up like a fan, the picture. Borrowing costs same from 1999 to 2008, and then suddenly Germany could borrow for a very low interest rate, Spain could borrow for a very high interest rate. This period when people didn't understand the fault lines and the entire Eurozone was being treated as a cluster, the Eurozone countries which should have had higher borrowing costs had an artificially lowered borrowing cost, and they overborrowed. So by 2008, when we've all woken up, we realized that for the first time, again, you're looking at a world which you could not think of earlier, where the fiscal parameters in Europe was worse than in most emerging economies. If you look at the total public debt to GDP, we were used to the fact that Japan always ran a huge public debt to GDP, 200%. But Europe used to be fiscally a very, very responsible place. But it is through no one's fault. It's a misunderstanding of some of the construction problems in the Eurozone, which gave rise to huge fiscal problems in Europe. Banks stepped in to save during 2008 and 9 to save banks, investment companies. Governments were stepping in, sovereigns were stepping in. And by 2010 and 2011, we realized that the sovereigns who were trying to save the banks and the private players, they were themselves now under risk. And that was the sovereign debt crisis of Europe that we are into. I want to turn to an analysis of what you do in this world, the world where the structure has changed. And I have to say, despite Europe's difficulty, I personally believe that the world has to move towards monetary union. There has to be bigger and bigger clusters of countries sharing the same currency, and that's the direction in which we will go. You see, if a cluster of countries go in for liquidity injection simultaneously, you don't have any impact, or you have negligible impact on exchange rates because you're all doing it simultaneously. And then also, the demand in your economy goes up because it's a bit like water. There are separate basins. If water is being poured into one basin with porous walls, it'll flow into the other basin. But if you're simultaneously pouring into all the basins, it won't flow out because each one is buoying up the water elsewhere. So there is need for greater coordination. And in the World Bank, in the IMF, of course, there is some talk now that we need to pay some attention to the coordination of global policies, simply because these have big implications, not just for those economies, but even for distant emerging economies. Most emerging economies, I can't give you numbers on South Africa, but I'm sure there will be people who will know. A lot of the population remains unbanked. 40% of the rural savings is held as cash by people under the pillow. So you literally hold cash because you don't have a bank account. You certainly don't put money in mutual funds. You hold it as cash. This problem does not arise in rich countries because virtually the entire population is financially included. But in an emerging country, when you go in for a period of financial inclusion, drawing these people into the banking system, helping them to put their money in banks, one very unusual problem can arise. Even if the central bank's policy does not change, Ministry of Finance, Treasury's policy does not change, when there is financial inclusion, you can begin to get an upward pressure on prices in the country, because during financial inclusion, money that had effectively been withdrawn from the system is being injected back into the system. So the money that was kept under the pillow, if with financial inclusion you help these people to open bank accounts and they go and put the money into bank accounts, the money goes back into circulation. So the effective money supply in a country begins to rise during a period of financial inclusion, and this causes lots of problems for the central bank, for the Ministry of Finance. This is not to say that financial inclusion is not a good thing, but this is simply to say that there are good things in life which have side effects which you have to contend with. In the World Bank, we are going through a period of very deep soul searching on what should the targets be. And we believe that extreme poverty eradication is important, but with that, there also has to be a sense of greater equity in some sense. You do want a better sharing, and we are trying to codify and write this. But this policy, when an emerging country is trying to pursue, look at the difficulties in today's changed structure of the world, globalized world. Again, I'm now going back to my Indian hat. People would very often say that, look, India ought to increase its corporate tax rate, or do something from this international capital coming into the country. We want to tax a little bit more of that. If a single country tries to do that, you can see what is going to happen. That capital is going to exit from that country and end up in another place. So a single country's, the policy that you can follow is clipped because of a globalized world where capital goes from one to another. You need some form of coordination of policies across nations to be able to get greater equity into a country. That is, again, in a country with some extreme inequalities, like in South Africa. You don't wait for that. And I would say exactly the same for India, very similarly for Brazil. Brazil has done very well, though, over the last 10 years or so in terms of equity. There is a lot to be done within your country, but there is also need for global coordination. And global coordination in equity policies, global coordination in monetary policies, fiscal policies, there is greater need for. inequality within countries is beginning to rise, and you're seeing this almost all over, is again to do with the change of the global structure. Eric Maskin and Michael Kramer have been working on this. It's a rather interesting, and to me it's a very, very plausible argument. See, in the olden days, one of the biggest barriers was for labor. If you're a laborer in a poor region, no matter how much your skills are, you cannot reap the benefits of that skill. But now with modern technology, you can sit in a distant place and still be a part of the global labor market pool, begin to do work for the global labor market. What does that mean? It means that for the relatively more skilled people in poor countries, you're becoming a part of the global labor force. Demand is going up for your services, so you become better off. So the top end of the labor market in emerging countries, poor economies, are becoming richer. And in rich countries, it's the relatively less skilled of the rich country that is getting into competition with workers in poor countries. And their earnings are being held constant while the country continues to rise. So the income gap is increasing in rich countries, income gap is increasing in poor countries because of the common labor pool that the world is becoming. What should you do about this? Not for a moment do I think that we should practice protectionism. Globalization, to me, on balance, has been good for us. It has expanded the global cake. We have to think of innovative ways of handling this kind of an inequality problem which is happening because of globalization, a globalization which is increasing the opportunities for people around the world, but it comes with certain strains. I've left you with a slew of open topics. For a couple of them, I have some ideas of how we should go about trying to solve. For the vast majority of these that I pointed to, I know what the problems are, but I don't have a solution. Economics is a very, very imprecise science. It is partly science. There are areas where we have very careful data, statistics, but there are also huge arenas where we don't know. And I think it's very important also for the profession to have that modesty and to know what it does not know, which is quite a bit. And once you're open to that, you exercise your mind, think of better ways of tackling the problems that you have to contend with. Problems that today, thanks to the small world we share across the world, whether you're sitting in Mexico, Brazil, India, China, it's problems that we share. And I'm glad once again that I managed to come here, share with you some of these inchoate thoughts, and hopefully this will be the start of a longer running interaction. Me personally, I would love to do that, and also with the World Bank and South Africa and the university, there'll be greater engagement. Thank you very much.